So you've managed to save a little extra money and you'd like to invest it in the stock market, but you're not sure how to do it? What am I doing in this park? Let's fix that.
In this video, we'll cover how to invest in the stock market for beginners in a way that will allow your money to grow without a whole lot of work. Sound good?
Let's go.
Let's do it. If you're a beginner, you should stick to the easy investing strategy I will highlight right now. But be sure to watch every part of the rest of this video quite a few times for more details. Easy investing strategy for beginners. Your time is valuable. Don't get carried away spending lots of hours and days researching stocks and trading strategies. The return on investment of your time will be very low if you're a beginner. Yes, it's good to learn more about investing, but you can actually make more money investing in yourself or starting a business with that time. If you have extra cash you'd like to invest to grow over time, it'll do plenty well with minimal time invested, simply investing it into an ETF, exchange traded fund, that follows the S&P 500 or the total stock market. Don't waste your time trying to time the market, being a trader, buying and selling. It's risky, and as a beginner, you will surely lose money, and I don't want you to have a bad experience early on being an investor. Keep it simple, save your time, and follow this advice, please. Simply invest into an ETF that follows the S&P 500 or total stock market, such as VOO or VTI. These assets have incredibly low expense ratios, both 0.3%, which is a small fee associated with investing in them. And what this means is that your investments grow in value. They won't be eaten away by hefty fees. I'll explain what an ETF is a little later in this video. Let your money grow over time, a long time, like 20 to 30 years if you're starting early. This is a long-term plan. The market goes up and the market goes down, but don't worry when it goes down, even if others panic. If you panic and sell, then you really do realize a loss. But if you just stick with the long-term plan, the market always goes up in the end, and so will your investment. The S&P 500 has had an average annual total return of around 10% over the last 90 years, and slightly better in the past 10 years, around 12.39% annually. Invest regularly. Set up your monthly budget to invest whatever you can afford on a regular basis, even if the market goes up and down. Using this strategy, you will accumulate more shares when the price is low and fewer shares when the price is high, averaging out the cost of your holdings. Realize that investing your extra cash into the S&P 500 will protect it from inflation. The purchasing value of the dollar diminishes each year. This is called inflation. From 1960 to 2022, the average inflation rate was 3.8% per year. So if your investment were to increase in value by 10% each year, your net value after inflation adjustment would be 6.2%. That's not bad. I hope that makes it clear that if you were to simply save that money in a savings account, earning zero interest, the purchasing value of your savings would diminish over time. With that said and done, now we'll get into more details about the stock market and how it works. You may have heard of stocks or the stock market and wondered what's it all about and how does it work. To put it simply, stocks are a piece of company you can buy, and the stock market is where you can buy them. Why would you want to buy a piece of company? Well, you'd want to buy a piece or several pieces of a company in hopes that it'll increase in value over time, so that later when you decide to sell it, you will actually make a profit. Now I got your attention. You might be thinking, how does it all work? How does a company sell me a piece, or shares as they call them, for let's say $10 a share, then later buy it back for let's say $15 a share, more than I paid? Why would they do that? Wouldn't they be losing money paying me back more than the original price? Well, this is how it works. Companies are in business to make money, and while doing business, they sometimes need to raise money to pay for projects they are pursuing in order to help the company grow. One way to raise money is to go public, as they call it, which simply put, allows the public the opportunity to buy pieces or shares of the company that was previously private. A certain number of shares are made available to the public for purchase, and a certain number are held private. Then, on a designated IPO launch day, the trading begins. An investment bank that underwrites the IPO, initial public offering, sets the initial price of the stock based on the current market conditions. the company's financial history, and how much demand there is for stock. Once the shares are made public in the stock market, that is when the demand, or lack of demand, naturally adjusts the stock price. If there is a high demand in the market, with many buyers wanting to buy the stock, sellers may demand more than the original price, and this can make the market price of the stock climb higher. Likewise, if there is little demand in the market with not many buyers wanting to buy the stock, sellers may be anxious to sell, even for less than the original price, and this can make the market price fall. So you see, this is the known risk involved with buying stocks in the stock market, and the risk varies depending on a lot of factors. You might be thinking, okay, that's great, Dave, but how do you invest in the stock market and actually make money? Well, to be honest, there's no guarantee you'll make or lose money. The price of each stock varies and depends on the perception of value the public has for it, based on the company's health and performance. The very basic strategy for investing in the stock market is to buy at a certain price, then sell at a higher price sometime in the future. The difference is the profit, less taxes you'll owe. This may sound easy enough, but depending on the asset you choose and the market conditions, there's always a certain amount of risk involved. But there are definitely ways to minimize your risk and increase your chances to make money. We'll talk about this in a minute. You may consider investing in individual company stocks, so we'll cover a bit of what's involved with reviewing a stock. But remember, the easy investing strategy covered earlier in this video is the easiest, safest way to invest in the stock market for beginners, sticking to ETFs that track the S&P 500. So if you're into easy and safe and sure, after you watch the rest of this video, go back to the beginning to focus on how to do it the easy, safe, and sure way. If you go to a financial website such as Yahoo Finance, Google Finance, or NASDAQ, these sites are all set up to provide helpful info on any stock that's on the market. Let's go to Yahoo Finance, for example. At the top of the page, there is a field to search for news, stock symbols, or companies. A stock symbol, also known as a ticker, is a short abbreviation used to uniquely identify a publicly traded shares of a particular stock. In the search box, start typing the name of a company and some matching results will start to appear, along with their stock symbol. To review info on one, click on it in the list. The page will load a lot of info specific to the company. Let's take a quick look. Up here you'll see the current price of the stock on the market. If the market is open, you may see the price changing. The market is open from 9:30 a.m. to 4 p.m. Eastern Standard Time, Monday through Friday, but is also closed on certain holidays. This price represents the current value in the market. Over here, you will see a chart. If you mouse over the chart, you can see that the price of the stock is recorded over time. The default view is the one-day chart, 1D in blue text, and this shows the activity for 1 day. If you click on other time frames, 5-day, 1 month, 6 month, year to date, 1 year, 5 year, or max, you can review the stock price of different timelines. As you can see, the price of a stock moves up and down according to the market value at the particular time. If you want to see a bigger and more sophisticated version of the chart, you can click on full screen. We won't get into reviewing this one. Perhaps I'll make a future video on that, and if you want to know the future of any stock, you can sign up for my membership newsletter. Just kidding. So back to the question, and with an added twist. How do you invest in the stock market and make money when it's always going up and down? It's a great question, and it's a matter of strategy, how much time you want to spend monitoring and managing your investments. I'll cover 4 strategies based on how long your investment is held in the market. Now, I mentioned previously that the basic strategy is buy at a certain price, then sell it later at a higher price, the difference being the profit. So the first strategy involves doing this within a very short time frame, like buying in the morning, then selling later in the day, or sometimes earlier the next morning if you expect the value to gap up the next day. To do this, you kind of need to be an expert. You need to have studied the stock and market sentiment to identify the opportunity to do this. It's not easy. If you don't know what you're doing, there's a high risk you will lose money. potentially lots of money. On the other hand, if you get it right, you could make a lot of money. Because you held your assets for only a short time, less than a year, you will pay the highest amount of taxes on these profits, short-term capital gains tax. And that's all I have to say about very short-term trading. Oh, and that I do not recommend this for beginners. There are also certain brokerage account restrictions for day trading that are a little complicated. You can look this up with your brokerage. The second strategy involves buying and selling within a window of a few days to a few weeks, also known as swing trading. To do this, you still need a higher level of expertise and knowledge about the conditions to identify the opportunity to buy low and sell high later, essentially. The risk with this strategy is also high. The profit opportunity can also be high. Again, because you held your asset for less than a year, you will pay the highest amount of taxes on these profits, short-term capital gains tax. I still don't recommend this for beginners, but because you're holding longer than 1 to 2 days, it's not considered day trading and you won't have any of those account restrictions. The third strategy is simply any trade that's held longer than a few weeks and less than a year. You may call it seasonal trading, as some might be taking advantage of seasonal price trends of the market. But there are other reasons you may hold longer than a few weeks and sell before a year is up. Perhaps you want to sell a losing asset that you don't feel will recover after a year's time. And so your strategy is to just sell before a year to claim short-term capital gains loss on your taxes. Again, you'll need a certain amount of expertise to identify these types of opportunities. I don't recommend this for beginners. The fourth strategy is one I recommend for beginners, and is basically the easy investing strategy I covered in the beginning of this video, which involves holding an asset for over a year. By doing this, your profit will be taxed at a more lenient tax rate, long-term capital gains tax rate. The level of expertise to do this is low. If you invest in index tracking ETFs such as those that track the S&P 500, total stock market, or NASDAQ 100, the risk is fairly low, the time spent to prepare for investing this way is low, and the potential gain is pretty good. At least you'll be surpassing the rate of inflation that devalues your money. Now, if you long-term trade specific company stocks like Apple or Tesla, it is more risky. You'll want to do more research, which is more time spent. You may potentially make more money than investing in a safe index tracing ETF, but you will also have just as much potential to lose money too. So you really need to be careful. Have a trading plan with definite points to cut with small losses before incurring big losses. You need to have more expertise. So one more time, I recommend the easy investment strategy for most people. Consider risk and time spent managing your investment. As you can see, no strategy has no risk. Depending on the strategy and asset you choose, potential gain or loss will vary. The amount of time, research and expertise required will vary, and the amount of risk and taxes owed will vary. So aside from the easy investing strategy covered earlier in this video, you will need to spend a lot of time to study and learn about stocks and various investment assets, how to read and understand company fundamentals and performance data, then how to plan your trading strategy, entry and exit, based on technical analysis, market price action, and risk-reward analysis. It will take time and practice, and you may pay for this experience with some losses, but with experience, you could learn to be a very profitable investor. I personally choose to use the easy investing strategy and save my time to make YouTube videos and build my business, but that's just me. Consider taxes. You need to consider taxes. It's up to you how long you want to hold stocks before you sell them, but before choosing a strategy, it's important to consider the tax implications on profits. It's really simple though, and you'll pay these taxes on your personal income tax return. Profits on sold shares held over a year are taxed at a long-term capital gains tax rate, lower taxes. Profits on sold shares held less than a year are taxed at the short-term capital gains tax rate, which combines with any other personal work income you may have. Since this will increase your personal income, it may bump you into a higher income tax bracket. It's important to consider how long your funds will be tied up in each investment. For example, let's say an emergency crops up and you need cash to address it. and the only cash you have is tied up in an investment, this could force you to sell at a very unfavorable time and lose money. If you're a short-term trader, this won't affect you so much, but if you are a long-term trader, this could definitely affect you. Investment types and what I recommend for beginners. While explaining how the stock market works and different investment strategies, I refer to trading companies. But you do have more options. Besides investing in specific companies, you can also invest in baskets of companies. These are known as mutual funds and ETFs. You can simply buy a share of one of these baskets, and you're actually buying a fraction of a whole bunch of different companies. This is good in certain ways because it diversifies the risk that comes along with buying a specific company. If one company in the basket performs poorly, it doesn't affect your overall performance that much. In fact, this is the option I recommend that beginner investors focus on. Well, not only me, but Warren Buffett, one of the best known and fundamental investors in the world, also recommends this.
If I had a choice today for a 10-year purchase of a 10-year bond at whatever it is, or 10 years, or buying the S&P 500 and holding it for 10 years, I'd buy the S&P in a second.
There are a ton of mutual fund and ETF equivalent assets to choose from. Some trace the major indices, others are focused on narrower selections of assets, specific sectors or regions. The two types I want you to focus on for beginners are the ones that trace the S&P 500 and the ones that trace the total stock market. For fun, I've included FNCMX and QQQ, which track the NASDAQ Top 100, the top 100 large cap companies listed on the NASDAQ stock exchange, excluding financial sector firms. Basically, an even narrower selection of the top large cap companies than the S&P 500. Brokerage accounts. Now we'll talk about brokerage accounts. If you look at this chart, you will see that mutual funds are available at less brokerages than ETFs. This is correct. For beginners, I recommend Robinhood or Webull. Both are available via a mobile app or web browser and have a simplified view that is great for beginners. Robinhood a little more so than Webull. With these, you can trade stocks and ETFs, and research is simplified and streamlined. Next is Charles Schwab and E-Trade. These are also both available via a mobile app or web browser, but in my opinion are a little harder to navigate for beginners. Because the brokerage industry has become so competitive over the last so many years, now none of these brokerages have a minimum account balance and none charge a fee to trade stocks and ETFs. Paper trading is a service that some brokerages offer which simulates the trading experience using fake money. Paper trading will allow beginners to get some experience trading before investing real money. Of the brokers mentioned above, Webull offers it for stocks and options trading. E-Trade used to offer it for stocks, but now only offers it for options trading. Robinhood and Schwab do not offer paper trading. Possible outcomes. Let's talk about all the money you can make on the stock market using the easy investing strategy for beginners method I mentioned at the beginning of this video. In this scenario, I want to show you the difference in outcomes between investing the same amount, $500 a month, over 20 years versus over 30 years. The difference in outcome between these is incredible. As you can see, investing the same amount for an additional 10 years really makes a big difference, and this is due to the magic of compounding interest earned. On the left, we invested $500 a month for 20 years, a total of $120,000 invested, and the accumulated savings plus interest is $379,684. On the right, we invested $500 a month for 30 years, a total of $180,000 invested, and the accumulated savings plus interest is $1,130,243. $379,000 versus $1.1 million? Holy cow, sign me up. So I urge you to start investing early. The extra early years of compounding interest will make it worth the commitment. You can send me a check to show your appreciation for letting you know about this, or at least hit the subscribe button. Investing in the stock market is a great way to hedge your extra cash against inflation and grow your savings faster. But before you consider investing in the stock market, I strongly recommend investing in your 401k, Roth, or IRA first to reap the benefits of tax deferment and employer match free money. I have a great video about 401k. You should check it out next. Don't worry, I made it super easy for you. Just click here now and I'll see you over there.